obviously we all want to keep more than what we're giving away, especially to our federal government. There's no doubt about it, right? They call it gross tax for a reason. It's disgusting what we send up to them. So it's important, I think, when we talk about perception.
How would you define an effective capital gains tax exit plan as it pertains to the psychology of money?
You know, I actually was looking forward to this when you invited me on your show. I appreciate it. I've listened to a lot of your stuff and I love what you're doing. I'd answer it this way, Brett, and I'm really actually curious your thoughts as well. As kind of an open discussion. And this is coming from a financial advisor, and I share this a lot because I obviously work with a lot of CPAs, a lot of tax attorneys, enrolled agents with our clients. To answer that question, to me, the word that comes up is perception, and perception is reality. And I share it this way, right? My grandfather once told me, he goes, "Don't trip over dollars to save pennies." And as a kid, I was like, I don't really, it didn't really register with me. And I've used that analogy sometimes with clients in that whatever transaction you're looking at, whether it's real estate, an after-tax holding or investment or whatever it might be. And obviously this depends on your tax bracket, because if you're in a higher ordinary income tax bracket, capital gains will be obviously more, incredible for you. Obviously, if you're around the same ordinary income tax as you are capital gains taxes, it might be different, which by the way is a great example of perception here. But the idea I'm trying to get at is I think a lot of it has to do with understanding, back to my original number one, at least from me, from a financial planning standpoint, right, is what's your why? I mean, obviously we all want to keep more than what we're giving away, especially to our federal government. There's no doubt about it, right? They call it gross tax for a reason. It's disgusting what we send up to them. So it's important, I think, when we talk about perception, that's how I'd kind of open that discussion, Brett, honestly. And obviously you're the captain in that chair, and you obviously are very, very well versed in that. And I think when we design, whether it's, Roth conversions, Roth discussions with clients, we design 1031 discussions, get the, accommodator inside of there for our clients, or whatever tax strategy it might be. I guess what I'm trying to share is we try to do it all relative to the client. Because I definitely, in our over 2,000 clients that we serve, we have, obviously we have varying different net worths. We also have very different backgrounds, which leads to my, understanding who they are, and then their perception of money. We have some clients that say, look, I understand I don't pay taxes, but the liquidity to me means more than the illiquidity. So you can't argue that, right? They understand the tax rules and they know it's going to go down. And as much as I'd love for them to defer it, right? They're like, look, the liquidity means more to me right now because I want to do X, Y, or Z. So I'd rather do that than other things. And so for us as a planning side, we get the easy chair, I think, in this scenario. You guys have the tough one of actually designing it, but we get to kind of sit with them and kind of say, okay, what is your goal with your money? Which is always a good question, right? Again, back to those three philosophies you should go into, right? And I think when you talk about taxes, particularly capital gains or an exit strategy as it relates to capital gains, it all has to do with the perception of the client and what their ultimate goal is. If they're okay paying the taxes, okay, great. Then it was obviously a successful transition or exit. If they're really tied up on not paying a single cent, then you're going to have to go through every strategy known to man, right, to be able to do it. And the best part about our country is, if you will, is we have a pretty open tax code with a lot of great strategies you can utilize. And I'm sure, obviously that's something that's right into your wheelhouse.
Absolutely, but I love the way you put that, and I think that's the key here. And how to build an effective capital gains tax exit plan always starts with you, the listener, you, the investor, you who have built that business, that real estate, invested in, a home at a good time and held on it for a long time, that cryptocurrency, that stock. And what's effective for one may not be as effective for the other. And defining if effective could mean liquidity. Of course, could mean diversification, could mean not having to deal with landlords, or not having to deal with a government or a state like California, who's so restrictive on landlords, not having to deal with, tenants, toilets, trash, termites, moving out of that big house that you feel like, you're real estate rich, but maybe a little cash flow light, and be able to defer that capital gains tax. If people want to learn more about what options are available, and that's key, because it's not just a one size fits all. There's multiple options. You can go to capitalgainstaxsolutions.com, where we can help you navigate different strategies as it pertains to the deferred sales trust in particular, but also Delaware statutory trust, opportunity zones, 1031 exchanges. Also get with Brad Barrett, who can also help you navigate it as well, and compare and contrast notes, because guess what? It's good to get second opinions and to figure out what's the most effective way. And sometimes it's both. Sometimes it's that donor advised fund coupled with the deferred sales trust. Sometimes it's that deferred sales trust coupled with the 1031 exchange. It all just depends on what you're trying to achieve. Go to capitalgainstaxsolutions.com. Brad, do you want to add anything to that?
No, actually, I love it. That's totally how we would design it too. And I think understanding the team you have in place matters, right? I've always told clients that a financial advisor, a good one, should be a quarterback to you, not the only team member, right? You got to have other people on the field, and kind of run the ball down the field for you. So employing a lot of people, comparing notes, multiple strategies is very important.